Alright guys, in today's video I'm going to go over a couple of trades I've recently made, beginning with the first one. I'll show how identifying liquidity hunting zones on the charts can provide us with high probability entry points that we can take advantage of. So let's jump right into the charts and break down what liquidity hunting means and how it's actually used by smart money. Now, a lot of times when we talk liquidity, what we are referencing is basically any significant swing high or swing low. However, when it comes to liquidity hunting, like on this 15-minute ES chart, if anyone is short at the top of this range, they'll usually have their stops placed just above the range top up around here. If they are long, the stops will logically be below support here at the bottom of the range. That means any price movement below support or above resistance of the range can be seen as areas of liquidity hunting. Which are obviously zones or levels where the market might be heading to, potentially offering a trade opportunity if price, and this is very important to remember, if price breaches, as is the case up here, breaches resistance but then quickly reverses by snapping back into the range, confirming this way the validity of the stop hunt zone. In other words, what we're looking for here is those smart money driven brief spikes outside the range where the extrinsic liquidity is pulled from all the stop orders. The goal from smart money is to trigger these orders to create favorable conditions for their own trades. And now, if we can catch a range breach that immediately gets faded, as in, price again quickly shifting back into the range, then that prime reversal signal, in conjunction obviously with other technical factors, should help you form a market bias. And that's precisely how I approached this trade, applying the extrinsic liquidity zone strategy. So as you can see on the chart, starting from this point down here, there's been a consistent uptick in buying activity, especially after this period of consolidation, indicating a strong demand within this entire trading range. The market then sells off. Drops one more time here before out of the blue punching through this previous high and the key 5260 level. Now, as price makes a new high here, it triggers a bunch of stop loss orders from the shorts positioned above the range's original high. But then we have also got additional extrinsic liquidity sitting outside the range. These are levels where traders have placed their unfilled orders expecting a breakout or a trend continuation. They are just waiting for the price to move in their favor. Basically, the traders going long have their orders sitting above resistance, and the ones going short, if we were always looking at the bottom of the range in a similar liquidity hunting scenario, have their orders set below support. Now, such actions create these pools of liquidity just outside the trading ranges, where all these unfilled orders are waiting to be filled. Now, this pooling dynamic up here triggers an impulsive move back inside the range as smart money absorb that available liquidity. So what we got here is a textbook, in my view, a textbook smart money liquidity grabbing move where the price spikes up, likely triggering stop loss orders. This is then followed by a rapid reversal, indicating that the stop hunt by smart money was successful in terms of clearing out liquidity. Now, such a move, although totally manipulative in nature, sets us up for a potential short trade. What makes this trade even more high probability, though, is this clear break in market formation or market structure. Is the same thing. However, it's not until we breach below the mid 45 support support level, a key flip zone, that the trade is truly on for the bears. And by flip zone, for those who don't know, by flip zone, I'm referring to, when the price breaks through a support level, that level often becomes a new resistance level. That's why I pulled the trigger on my short entry at this particular point. In terms of targets, one contract hit its profit mark, but unfortunately, I got stopped out on the second one. Certainly not a perfect trade, but I think that the liquidity read and setup was on point. Next up is another trade, and this time we are looking at a long position on the Nikkei, as you can see on the chart. So the moment I spotted this price action and looked at some technical details, I could tell that this setup had some real potential. So let's zoom in on the chart and break down why I decided to take this particular trade. Now we know that extreme bearish sentiment like this 400-point dumper here often sets the stage for an upswing in asset prices. Based on that assumption, following this apparent 15-minute shakeout move down here, where price briefly dips below the range support level. And for those new to trading, these shakeouts or springs act as a test by market makers to gauge the available supply before allowing price to bounce back within the range. So after printing back inside the range, my expectation once we cleared the 5-day EMA and broke market formation was for price to find equilibrium from the low to this rebalancing point up here on the chart. So the key factors at play here are equal lows indicating weakness, the shakeout move, testing supply, price acceptance back inside the range, clearing the 5-day EMA and breaking market formation, and lastly, price establishing equilibrium low to high of move. Now, looking at all these technical factors, I'm seeing a prime long entry setup once price successfully retests and holds this key flip zone as support. And now, sure, we did get this weak quickly poking below support here, but that was just a fleeting rebalancing move to the downside before the upside momentum kicked back in. Like I always say, guys, it's the candle bodies that reveal the true narrative, not the wicks. With this retest here holding firm at support and all other ducks lining up, we had all the criteria, I think, filled for a high probability long entry to play this rebalancing move higher. That's why I pulled the trigger with two contracts right at the 340 level. Now, one of the contracts, as you can see on the chart, hit the target, but unfortunately, I got stopped out on the other one. Funny enough, though, the market did eventually reach that second target after taking my stop loss. And, I'm totally good with that. At the end of the day, it's not just about being green, but also executing the right strategy when the setup is there. And I think I achieved that on this trade. And by the way, if you are interested in similar strategic type trades, make sure not to miss the next video. All right, gang, thanks for watching. And as always, hope to catch you all in the next one.